Hello everybody, and thank you for joining us today for our fixed income webinar. Today we'll be covering the fixed income markets, and to set the backdrop for this discussion, firstly I'll turn to Bastian, and then I'll be covering the other panelists from my left, Vishal from our bonds team, Michelle in our credit team, and Michael in our cash and income team. So Bastian, first to you. Let's look at the backdrop that we're dealing with. We've had the Iranian oil crisis effectively shocking the markets, but there seems to be a disconnect between the way markets have reacted and what's actually going on in the fundamentals. Can you give us a sense of how you're seeing things?
Yes, thanks Murray, and thanks everyone for joining. I think for starters we must say that the headlines have been dominated by talk around inflation, talk about higher interest rates for longer, and the reality is that we don't really measure any weaker economic growth. So global economy has kept that quite well so far, and we don't really measure any pickup in, let's call it, demand side driven inflation either, so it's more supply side driven. So with that, there shouldn't be too much fear of higher interest rates, yet we've seen quite a lot of dislocation. So you ask, where do we see most dislocation? From a regional point of view, we are of the opinion that interest rates are now too high in the United States, in Europe and in South Africa. So it's not a question of regional dislocation, it's dislocated pretty much everywhere. We're going to talk a lot about credit today as well. From a credit point of view, there's not too much dislocation either. There's obviously dislocation in the sector, but spreads have not widened aggressively, and we also think they shouldn't have widened aggressively. And last but not least, if we look at the curve, then that's where we see dispersion. So we do think that the back end has moved a little bit. Maybe it should have moved a little bit based on different risk premia now. But interestingly, the front end, we see that as really dislocated. In the United States, we priced for no further interest rate cuts this year, which we think is too aggressive. And in South Africa, we even priced for interest rate hikes. And that exactly creates an opportunity at the front end of the yield curve.
Thanks, Bastian. Michael, turning to you on the SA rates and the reaction that we've seen early on in Q1, post this oil shock. How did the South African market react, particularly reflecting what Bastian said around the full extent of the curve?
Yeah, thanks, Murray. I think a good point to start would be heading into the last quarter of 2025, where we saw interest rates. The FRA curve at that point in time which is the market's best estimation of where short-term interest rates are going to be, was pricing for 2 cuts in the market, bringing our local short-term interest rate down to about 6.5%, just below 6.5%. What we've seen from the oil-driven crisis from the Iranian conflict is that has been twisted on its head entirely. What went from 2 more cuts in the market went all the way at its peak to 2 hikes in the market. So that's a 1% shift in front-end rates over the short term. So that's quite an aggressive move. We've seen that come in quite a little bit now, with only 1 further hike priced, before resettling down to where we currently are towards the end of 2027. But really nothing was insulated in this last sell-off. Front-end rates weren't insulated, back-end bonds weren't insulated, even equity markets, gold, US treasuries, traditional safe haven assets also experienced the brunt of this sell-off.
Okay, thanks Michael. Bastian, we were potentially in an interest rate cutting cycle globally, but with this oil shock, we clearly have the expectation around the world that this could be inflationary. What's your view on the supply side, and whether we're going to see these interest rate cycle move back into a hiking cycle potentially?
Yeah, we wouldn't think that it should be a hiking cycle. That's what we priced for, and I think Michael alluded to the front end of the SA curve where we priced for hikes. Having said that, this is a very classical example of a supply side driven shock, and just having high interest rates won't increase supply at all. So it's not really the answer to the problem. That would be the right answer to a demand-side driven shock, but it's simply not that. I think to answer whether we will see higher rates across the board and how severe this shock is, we need to also look at the x-axis. So don't just look at whether we see inflation rising now. The question is also, like, how long is inflation priced to be higher? And for that, there's some interesting charts which we would love to look at. So let's start by having a quick look at what happened to inflation over the last couple of weeks since this crisis emerged. So just looking at headline inflation at the right-hand side, you can see there's a little bit of a spike, which is obviously driven by the rising oil price, and we can see that prices generally do react on that. We've moved from 2.4 all the way up to 3.3, so that is a little bit of a spike. Not that meaningful as we think, but it's something. It becomes more interesting if you look into the decomposition of inflation. If you look into the decomposition of inflation, we've done this many, many times before. You see all the individual drivers of inflation. So if I would add up these bars, they would add up to 3.3, which is the last inflation print. There's two interesting ones here. The shelter component, which we've long been arguing, is on the way down. The typical demand side driven inflation, that's still on its way down. Now the second large driver is now motor fuel, which is the direct feed into, or basically the result of a higher oil price, and that's now the second largest contributor to inflation. Motor fuel or oil shock, typical supply side, shelter component, typical demand side. So let's just look at these two components a little bit through time and decompose inflation a little bit further. So on this chart you can see once again the makeup of the last inflation print goes all the way to 3.3 on the line chart, and the underlying bars are basically the drivers. What I'm going to do is I'm going to switch everything off so that we basically have no contributors left, and then we'll look at shelter, which is a typical demand side driven part of inflation, and compare that to motor fuel, which is typically supply side driven. Demand side driven inflation, proxied by shelter in this example, still on its way down. So absolutely no shock. This includes the crisis, it includes the March print. So yeah, we shouldn't hike rates because that could impact this one here. If we take that down and look into the motor fuel contribution, you can see the oil shock on the right hand side. So we had a detraction from motor fuel or from an oil price over the last couple of months. Now there's a positive contribution. 0.6% of inflation is driven just by motor fuel. Can you combat that through high interest rates? Certainly not. So with that, no point in hiking rates. We take it one step further and look forward into inflation expectations. For those of you who think we only looked at the past so far, let's look into the future. We can do that by focusing on inflation expectations, i.e. the one-year inflation swap. And if we do that, once again zooming in to focus on the crisis, you can see on the right-hand side, coming from the end of Feb 2.9, that's expected inflation for the year out now. I call it 2.6 rather. We've now spiked up to 3.13. So we've moved up 50 bips on the one-year basis. So that's something again, but again, not too dramatic. If we take the 5-year inflation swap though, and we think that's far more meaningful, and we overlay that, you can see that there's basically no reaction to inflation, so to the oil price shock, and inflation expectations really haven't moved. So obviously we know that monetary policy is impacting the real economy with an 18-month lag. So with that, there's never a point to hike interest rates based what's happening to the one-year inflation swap. You can only tackle the back end, the 5-year shock, and based on that you shouldn't be hiking. So long story short, there's two reasons not to hike interest rates. First one is the shock is clearly supply side driven. The second one is that even if it would be demand side driven, it's already priced to be quite short-lived. Okay, so Murray has shown by the charts and illustrated basically two strong reasons to not hike interest rates, and we think that's where the opportunity lies. We priced for hikes, but the hikes shouldn't be delivered.
Vishal, turning to you in the bond market, Michael covered the short end of the curve and the opportunities that arose there for us to take advantage of. Give us a sense of what played out in the bond market and how Prescient sees the opportunities in that area.
Yeah, sure. So currently we see bonds as being quite on a diversification basis, still a great play to have. In particular, we think primarily because where real yields are right now, they're quite attractive for locals and for foreigners offshore. At present, we look at a bond portfolio allocation to be strategic and not a tactical play. So we sort of allocate in such a way to harvest term premium and the yields that these bonds offer at this point in time. And I think in particular, the current cycle that we're seeing right now, the risk of cycle, is driven by three things, or it's not literally just a risk of cycle. It's driven from a energy shock, so high oil prices or gases as well, a higher logistical shock where we're seeing the Strait of Hormuz, the shipping disruption taking place there, and also funding costs. We're seeing dollar being high at this point in time. I think within South African space, how that's playing out is that on the one hand, we have high oil prices, so inflation fears are there. But then also we have a weaker rand. But on the other end of that, and sort of benefit of us is that we have commodities which are being quite positive at this point in time and being quite good. So it's sort of counterbalanced in some sense. So I think the key point there is that on a valuation basis, we still believe that bonds are showing quite a lot of value and a lot of risk has been priced into them. And hence we have high conviction on holding bonds at this point in time.
That's great. Thanks, Vishal. Bastian, turning to equity markets effectively, it's saying a while back, not too long ago, there was a big shift towards emerging markets again. Valuations are looking appropriate. And from a South African context, we were also seeing an upswing. But then all of a sudden, with the shock, we saw a significant turnaround in that attitude. Maybe just talk around how we see that playing out and from a South African fundamentals perspective.
Yeah, I think nothing has changed with South African fundamentals in a bad way, not at all. I mean, our inflation trajectory is still downward sloping, even if we have a little bit of a short-term, as showed previously, short-term shock to inflation with a weaker rand and short-term higher oil prices. But at the same point in time, long-term fundamentally, the deflationary trend is well in place. We've got a new inflation target. We've got it off the grey list. Lots of positive fundamentals. None of that has changed. Having said that, when we had a very strong bond rally last year, not us, but a lot of the media erroneously would link that positive bond rally to local specific South African factors, and that was wrong in the first place. The vast majority of last year's bond rally has been driven by global factors, and if we look at it right now, what's driving the sell-off? Once again, 100% global factors. So for South Africa, nothing has changed. We're in a better space now or last year than previous year with a lot of things coming right. But is that the core driving force behind our bond market rally? Don't think so.
Great. Talking about capital markets, Michelle, turning to you. Debt capital markets, we had seen a lot of interest in the South African credit space. We'd seen yields compressing, lots of issuance, demand. What's changed?
Yeah, it's been quite a interesting quarter, I'd say. But if I were to sum it up, I think the credit market, it's coming more from a technical perspective rather than driven by fundamentals. And that's purely because of the imbalance with supply, lack of assets in the market. And that's driving demand and spreads ultimately. And if I were to sum it up in three key themes, it's strong demand, continued compression of spreads, and very few new assets coming to market. So interestingly, if we're just looking at issuance, for instance, has been quite muted if we compare year-on-year figures. So for the quarter, there's been about 30 billion that's come to market. That's 3 billion down on a year-to-year number. And if we compare that on a quarter-to-quarter basis, that's down about 20%. So clear sign of fewer assets coming to market. And then further down, if we're looking at a sector basis, financials is leading in this space where we're seeing banks actually at the forefront. They've issued over 15 billion just in this quarter, and this is driven by the transition to issuing more first loss after capital type instruments. So they've issued 15 billion, we're expecting it to end at 70 billion. So a lot more active participation from them in the sector. So there's a lot of activity. On the corporates and state-owned entities, very muted there. It's down 20% versus 40% respectively. Corporates are looking to private placements rather because of the volatility. State-owned entities also staying away. For a bit, we've only seen two issuers, Transnet and IDC. So overall, banks financial is the leading indicator here, and that we will see going forward as well. Coupled with all of that, we're seeing quite a high liquidity in the market. That doesn't necessarily help investors because of the chase for yield. And so banks are also quite active in terms of their participation, sometimes taking up 30% of corporate issuance. So that's quite starking if you think about it, and that's purely driven by their balance sheet demand, but also wanting to hold that high quality asset. So overall, if I were to sum it up, it's literally because of the supply imbalance in the market at the moment. That's going to, I think, still on a forward-looking basis, still continue.
So to sum it up, lots of demand for the credit space.
Yeah.
We like credit as a diversifier in a portfolio, but I guess the question has to be asked, are investors like ourselves being compensated now, given that these spreads have compressed so much?
Yeah, I mean, I think Bastian also touched on it earlier that from a South African perspective, we're not really seeing quite a shift or spillover effect of these global factors into the credit market. That is, in this asset class specifically, it's quite resilient, and we've seen specifically in our process, the probability of defaults not necessarily worsening per se, and so issuers are seemingly quite resilient despite the noise that we're seeing in the market. Of course, from a process perspective, our monitoring is key. So we are monitoring quite closely to make sure that we are compensated for it. And if we just use JIBAR, say it's between 6 and 7%, so use 7%, we are still able to get spreads around 2%. That's giving you 9%. So on an overall perspective, it's still giving you quite a decent yield. So despite all of the supply dynamics, lack of assets coming to market, we are able to leverage quite a bit of other tools in our bucket, such as structured products, for example, that's able to give us a credit premium relative to other traditional type debt or credit assets. And so we use the pool, we use diversification as at the forefront of what we do. So if I just to sum it up, that there is still a pool of opportunistic valuation in the system. Credit isn't as volatile, it gives you consistent returns, so it's very much still an asset class that we look at.
Thanks for that. Very comprehensive, but I guess as you're stating, you've got to be very discerning about what you're taking on and constant review of the credit name, given what we've seen in the market, which is from a liquid perspective obviously being quite volatile, and so we touched on that visual in the bond commentary. But I think just turning to the portfolio management of a bond fund in particular, we talk about our systematic process, and we have a very strong methodology and investment framework within the systematic approach to managing assets. Within the bond space, then tell us how this framework works, particularly when you're seeing quite emotional reactions to this bond volatility. Particularly, I guess, people saying, is it time to buy or sell? But we want to avoid that from a systematic process. So maybe just unpack that a little bit further.
Yeah, for sure, right? So, I think this environment we find ourselves in right now fits in sort of perfectly into what we do at Prescient, right? Being a systematic house, we look at the data and to try and find signals for us to find value, right? Which I think is absolutely great, right? So now, in terms of the bond space, we obviously have various factors which we find which have high expansion power on a statistical basis, which then are used in our model to arrive at some expectation as to what the yield curve will do over the next while. Now, this value is completely unbiased, right? There's no human emotion or views into this, which I think is a great thing. And then secondly, also, our process allows us to look at mispricing in the market, right? So when the market sells off or spikes quite high because of some event, we try to look through that noise and find signals in terms of finding the value to now invest in appropriately into various bond portfolios, right? So obviously our process now gives us a optimal portfolio, which we then go invest in. And currently what it's suggesting is to invest in the back end of the yield curve, where we currently invested in 2044s and 48s at this point in time. So like in duration at this point in time,
okay,
based on our models.
Thanks. So the opportunity was to take on some of that duration given the valuations. We've done that. Now that it's playing out, you're lightening duration again. Okay, great. Michael, from a risk management perspective, part of the systematic process is a very strong focus on risk management for obvious reasons. And with that in mind, talking about income provider, the Prescient Income Provider Fund, our large income solution in the multi-asset income space, maybe just cover a little bit about the risk management process that we apply there. Because effectively what we talk about that fund to investors is safe capital, income generation. You don't want to see lots of unit price volatility over time. So inherently, where you have an investment vehicle like this, you can use the full spread of short end, long end credit, etc. There's lots of moving parts. So the risk management becomes even more important.
So whenever we talk about the Prescient Income Provider Fund, the key thing that we have to always start with is our strict risk budgeting process. And for us, that means that we don't want to lose any client money over any rolling 3-month period. So if you were to invest your money today, in 3 months' time, if you were to go and check your investor statement, we'd want to at least have your capital balance the same as what it was when you first started. This is especially important given that it's an income fund. People are using this for pension withdrawals. People are using it for retirement savings. means, so we need to be careful. We don't want too much volatility within the fund itself. And so for us, that's the really important base for how we manage risk within the Prescient Income Provider Fund is when we start our whole portfolio optimization process, when we start looking at how we're going to form a portfolio, first we must look at what is the risk that underlines the portfolio, what is the risk that we get out of our positions, and how can we build the most effective portfolio given that risk budget that we have in place.
Michael, you talk about risk and I guess the opportunity to take risk at various points of the curve. And obviously the opportunity from a bond perspective was to put on duration when it was opportune. I mean, that has some significant risk characteristics. How do you manage that, and what activity did take place over the last quarter?
Sure. To go back to the last quarter of 2025 again, we really started to take off risk in the income provider fund. And that was largely due to the fact that we felt like duration assets weren't giving us sufficient return given the risk characteristics that they face. We felt that the market was heavily complacent, and one of the ways that we measured that was via measuring how much it cost to buy protection against rand weakness. The best way for me to show it would actually be to show you this chart over here. So what I want to show you here is the SA bond 10-year view. And what I've done is I've taken us back to the 1st of February before all of the Iranian crisis happened and the Strait of Hormuz closure. And what you can see is that we were quite negative on the 10-year bond, which we're using now as a representative bond for the yield curve. And that was mainly due to the fact that sentiment was strongly negative. You can see that on a score of -1 to +1, we were at -0.86. And that, as I mentioned, was largely due to the USD ZAR risk reversal, which essentially measures what is the cost that you have of buying protection against rand weakness versus rand strength. And for us, when it's very, very low, that means it's very cheap to buy protection on rand weakness, and when it's high, it's very expensive to buy protection on rand weakness. And what this means, if we look over the last 6 months, is over the previous 6 months, it was very, very low, well below its median range, which means that the market was acting as if it was complacent, as if there was nothing that was going to go wrong. And so people weren't buying protection, and that's therefore protection went very cheap. So for us at Prescient, we use this as a contraindicator. So when volatility, the price of buying protection against rand weakness is very low, we all want to be underweight the SA bonds. When it spikes and goes very high, we want to be overweight SA bonds because we believe that the market is panicking, it's overpaying for protection, and we expect the price of that to come down. So as I said, in the Q4 of 2025, we took off duration because we thought the market was too complacent. And what that meant is that when markets sold off, and this especially started to spike, as you can see it here, all the way up to about 5, we were able to lock in opportunities there and buy back-end duration as well as some front-end duration. And what we've seen since then is that the front-end FRA curve, as I mentioned in my first point, has come down quite a bit, going from 2 hikes priced to just 1. And this risk reversal has returned all the way down to its long-term median around 3. And so we've been able to profit by taking in those about 8% in back-end duration, and then in buying 1-year fixed-rate instruments and seeing the benefit from that. So that really highlights how we were able to use our asset class views as well as our expectation of returns along with our risk budget to build a portfolio that is cautious but can still take opportunities where we see. And this is a perfect example of how our risk budget managed to save us from getting burnt on the up and allowed us to participate coming down.
Michael, that's great. I think what you touch on is this concept of portfolio construction and judicious portfolio management. I mean, Michelle, turning to you, about the Income Plus Fund, which effectively also uses a large portion of credit and some level of duration assets. But how are you thinking about the Income Plus Fund and the use of credit in that portfolio, given all of this geopolitical tension and potential rising inflation and rates?
Yeah, thanks, Barry. I think we are consistent in the way that we use diversification as quite a key element. And even though there's noise globally with all these tensions and volatility in the market, diversification is quite key in terms of how we position the fund. We are monitoring to make sure that spillover effects from these global market developments does not occur, and if it occurs, making sure that we compensate it for the risk that we are taking on. And so, having said that, the fund in itself, speaking of Income Plus, we position, obviously, we put an emphasis on making sure that we have consistent income and performance for our clients, and it's best showcased through our portal. So from a positioning perspective, while our approach remains disciplined and selective, we choose high quality assets, specifically in sectors that remain resilient. So for Income Plus specifically, as you can see over here, we've been able to outperform our benchmark, and even though there's been quite a lot of noise and volatility in the market, performance has been up year to date. So that's given us a March gross yield of 10.3%, and in a market that is quite volatile, I'll say that is quite good. From an MD perspective, we've taken on some duration, but that's through our bond trades informed by our bond team, landing the fund at 1.6 year modified duration. Speaking on some trades from a positioning perspective, if I can name only two, so we've taken on some government guaranteed notes and some bank paper, subject to about 400 million, and that's taken the fund size from 5.9 billion to 6.5 billion. So even though with the factors mentioned, such as the volatility, the lack of supply and assets in the market, we've been able to outperform our benchmark, even though we have all these constraints in the market at the moment. And so as you can see that the fund has remained quite resilient over time, and that's thanks to the diversification aspect of the fund and having to put capital preservation for our clients at the forefront and risk management at the forefront of what we do. So it ultimately shows that the fund is resilient and is able to still outperform even through shocks.
Thanks, Michelle. Just through all of this, I guess the audience or the people listening that maybe don't know Prescient too much, as we keep talking about systematics and models and optimization, one could possibly believe that it's all very much computational or driven by machinery. But I think the point around systematic is that it's actually evolved with humans, improving on processes, which is through mathematical and scientific models, the inclusion of data and the improvement in the sourcing of an ever-increasing data series. And so the human element is really around the improvisation of that systematic process to ensure that the rigorous models and optimization that we actually utilize all work together across the various teams that we have to ensure that we are generating the most appropriate returns for our clients with the appropriate level of risk. And so, Vishal, this constant evolution of our process is improving what we do. That is a human element. So maybe just bringing it back to the bonds team, in your valuation metrics that you look at, we've seen lots of volatility. What gives you conviction, for example, around the South African bond market, given what we've seen of late? With reference to what I've said now around you're constantly trying to improve a process, and that's the team putting in or reworking models or finding new mathematical methodologies to do this.
Yeah, I mean, as mentioned earlier, right, we at the moment have high conviction in bonds and having duration in our allocation at this point in time. And I think that high conviction comes from the observable data that we see out there, right? It's not from myself or anyone else making a call in terms of how we're going to position, but absolutely looking at observable data and seeing whether we can see signal, right? And I think in particular right now, the two factors that we think shows quite a lot of expansion power in terms of where the market is right now is firstly the real yields. Right now, they're quite elevated at these levels right now, actually a lot higher than they trend at this point in time. And the second one is term premium, right? So at the moment, the term premium is quite wide at this point in time, indicating that locally and globally, right, there's a lot of uncertainty in the market right now. So we think that bonds have obviously repriced this risk, and as a result, sort of adjusted quite a lot for this risk, and we've tried to take advantage of it, but holding extra duration in our portfolios, right? So when you look at valuation factors, other valuation factors, things such as inflation expectations, as I mentioned, real yield, term premium, currency dynamics, and seeing how those play out, funding constraints, and in particular looking at the US dollar and how it affects the rand dollar currency. And I'll just show you a chart which breaks down the US 10-year components into its various components. So the following is a decomposition of the US 10-year bond for this year currently. And I think what quite interestingly, what we can see is that, I'll scroll down slightly, but average US average expectations of inflation has crept up by about 20 basis points. However, interestingly, right now it's around 2%, right? Which is pretty much where the Fed targets inflation within USA. So which indicates that, inflation, yes, we're seeing inflation fears are out there, but it hasn't really spiked out. And in the long term, market is not suggesting that inflation will move away from the current trend we see right now. I think also interestingly is that if you look at the inflation risk premium for the USA, it has actually come lower by about 11 basis points, indicating that market has confidence that the Fed will get it right over the next while. So as you can see, right, inflation is not spiking up right now. And as mentioned by us earlier, right, I mean, markets have repriced higher, but it's not really a concern for us or the market as it is right now. And as a result, markets have now repriced higher, and we've tried to take advantage of the value that is out there. I think interestingly, if you look at the BOJ, the BOE, the Fed, and even the SARB, right, they all seem to align in terms of their policy, right? In the communication has been that they are talking around looking through this first round effects and looking to see where the second round effects actually play, and then they will start to react, which is quite interesting. And as a result, we have this high conviction to hold duration in our portfolios.
Right, thanks. Vishal, that kind of talks to the back end, but I think starting to close this off, I'll go back to you, Michael. In the South African context, we've got a new inflation target framework that the SARB is obviously looking at, and looking at this inflation, shocks that may come. Obviously, we were, as I mentioned earlier, everybody knows we were potentially in a rate cutting cycle, but now the SARB is going to review all of this. What does it mean for the rest of the year, particularly in the cash and income portfolios, and how are we positioned, and what do we think is going to play out?
Sure. I again want to go back to the FRA curve and just to talk about how there's still one hike left priced in the FRA curve. So the market has an expectation that the SARB in the next 6 months was going to hike once, and that really came into play because of this oil-driven side effect. And as Bastian said right at the beginning, the oil price is a supply-driven effect, not a demand-driven. And monetary policy, as we know, has no impact on supply-driven things. So if the SARB were to hike, all they would be doing is slowing the economic growth down. They cannot control the price of fuel, they cannot control the price of the gas, they cannot control the price of oil. And so the risk, the real risk, I think, is the risk that the hike has been mispriced, and that's where the opportunity to make money. So we think if the SARB is credible, which we believe over the last 20 years they've been working themselves up to show that they are credible, and particularly with this new 3% inflation target now that they have a fixed point of 3%, they can say, well, look, in the longer term, do you trust us to get to that point? And if you do, then we can temporarily look through this transitory shock. As we know, oil prices are, as I said, nothing that they can control. So it is something that they have to say, well, we will look through this, and you trust us that we will be able to bring inflation back down to 3%. And if they do that, and if they are credible, which we know them to be, then what we can expect, or hope to expect, is that there's no further hikes priced in, and therefore there's opportunity for front-end rates to come down further from where they are. And so for us, that's really where we've seen value added in the 1, 2, 3 year space, even in the front end of the South African curve, where we would expect, or we hope to see yields coming down and compressing. And even if yields don't compress and they stay where they are, if you have an inflation target at 3, if the SARB is running with a credible inflation at 3, call it even 4% with this slightly transitory shock, you're still earning yields of 7, 8 and a bit percent. So you're earning CPI plus 3, CPI plus 3.5 in the front end if nothing happens. If rates come down, obviously you get a boost from that as well. We trust the SARB to do the right thing. We trust that they're credible. They've been spending, as I said, the last 20 years building up a balance of credibility that they can afford to spend a little bit now to say to the markets, let's look through this oil supply shock and see what's going to come.
So I think we've said a lot. Let's bring it all together. Bastian, maybe some closing thoughts from you. But where we're at right now is we've got, as I say, lots of moving parts. Oil moving or shipments moving through the Straits of Hormuz need to be sort of sorted out, and we hopefully get some positive news again on that front. Markets seem to be reacting on a positive front to that. We know that there's lots of stuff that gets moved through there. All of this is impacting the market, as we've said. But what do people need to think about for the remaining sort of solid months of this year, given that we're through quarter one? What's your guidance for us on this front?
I guess the most important part is always is to keep calm and maybe look into history and take some learnings, get the empirical data or the empirical evidence, data-driven decision-making. That's what we should be doing. So if we can learn from history, if you look at the last 3 oil crises, first one, call it early 70s, we had a massive oil spike and we had massive inflation and we had the central bank not reacting, so everything kind of went wrong. But at that point in time, we must keep in mind that the Federal Reserve didn't have an inflation target. So that was a very different regime. The regime thereafter, they were a little bit smarter. They introduced inflation targeting. And what we had in the late 70s, early 80s, again, massive oil spike. But now the central bank, or like the Federal Reserve, reacted aggressively, bringing down inflation aggressively through aggressive rate hike. But it led to a massive recession. And then in the 90s, we had the last oil shock, and that's the one which we should reference now. And now the Fed has established credibility because they brought back inflation before. So what we had there, we had an oil spike. It was short-lived. The Fed did not have to hike. Inflation came down quickly as expected. And the Fed actually ended up cutting interest rates to boost the economy. So if you just take those steps and use the past a little bit of a guidance to the future, we've got central banks in the US and in South Africa which are very credible. They know that this will have a negative impact on the economy. They know it's short-lived. There's absolutely no reason to hike interest rates. So with all of that information, markets are always volatile. There's a lot of headlines dominating, but our systematic process is able to cut through that, use the information of the past, apply them to the scenarios of the future, and we always get the best outcomes for our clients.
Thanks, Bastian. Thanks, Vishal, Michelle, and Michael for joining me. Folks, to close off before we have questions, just I think, if I may, what we've been talking about is our fixed income suite of funds from a domestic perspective. We do run global income portfolios, but we're talking about everything from corporate money market, yield quant plus, income provider, and our income plus fund. And of course, not to forget the bond funds, our flexible bond fund and portable alpha bond. So guys, thanks for sharing the views with everybody that joined us today, and we'll take a few questions. Thank you. Okay, thanks. Turning to some questions, guys. Thanks for joining me for the question section. Bastian, I think just given what we've spoken about and the ongoing flow of new news coming out of the Straits of Hormuz, I mean, really we've got possibly the biggest shift in oil supply globally, which is going to have probably second round of inflationary effects on the world. But let's just bring it back to the South African context where we all live. I'm sure there's some people that have dialed in for the webinar from abroad. Well, we hope so. But obviously the majority of us on this call are concerned about domestic interest rates and how that plays out and affects portfolios. So let's just turn back to the SARB, the inflation bands that have been adjusted, and particularly the expectation for rates given this oil shock.
Yeah, I think as we said in the webinar, it really is important to look through this short-term spike and ask yourself the question, how long is inflation going to be higher on the back of it? And normally higher oil prices mean that inflation is higher for not much longer than 1 year. That's exactly what we also anticipate. And with that, you should look through that cycle and you should not hike interest rates. At the same point in time, it's a purely supply-side driven shock. So at the risk of repeating ourselves, but that is again something which you wouldn't tackle with higher rates. So 2 good reasons not to hike rates, but rather to cut rates. You're still priced for 1 to 2 more hikes this year, which means there's room for rates to come down compared to where they are right now. So for us, where interest rates going, certainly not up. They should come down from here.
Okay, so we'll sit flat for a while, look through this, as you keep saying, see what the second round effects of inflation, then hopefully we'll have a cut. Michael, maybe to turn to you from a rates perspective. No, so we mentioned the short end, or call it our cash and money market portfolios. Talk about income provider as well, which is a fund that delivers all of these funds that are delivering an interest rate, a solid performance, no volatility in unit price. And then you go to the back end of the curve, and there particularly look at the bond funds. I mean, given this interest rate cycle, for clients positioning from a safety perspective, the short-end funds should do well in this kind of environment where you'd expect maybe some volatility at the back end of the curve. Maybe just put some comment in that for us.
Yeah, sure. Thanks, Murray. There's certainly a place in everyone's portfolio for a bond fund or a short-term cash fund or an income fund. And I'll try to stay away from the back end of the curve for the moment and look more at the income space. And I think this is really an attractive scenario and position for income funds at the moment. We have quite high rates, given what we've seen being blown out from going from cuts to hikes now on the front end. And as Bastian just mentioned, the SARB is unlikely to hike into a supply side inflation-driven event. And so while they may not cut, you still have those higher rates for longer. You have inflation, sure, maybe on the 1 year time frame it's going to be a bit higher, but looking forward, inflation is still going to be around that 3%. We know the SARB is credible in what they say. So you've got higher rates, you've got a lower inflation target, which means you've got on the front end quite an attractive value proposition in terms of your real yield that you're earning from your instruments. And if we look at the FRA curve that we showed in the webinar earlier, there still is a little bit of a hump in there in the middle. So in the event that the supply side shock fizzles away, as we would expect it to do, and the SARB not to hike into that, there's still lots of opportunity in the front end for rates to come down, which obviously then benefits your positioning. So we think it's quite an attractive place to be. You've got attractive rates. You have really, they certainly aren't going to cut rates. Well, they will hopefully cut rates from here, but we think they're unlikely to hike rates. So you've kind of got an upside bound on where you can see rates going. So you've got some natural built-in protection, and you've got attractive real yields heading forward. So I think it's a great place to be. Obviously, it depends on what your portfolio is constructed that you want to achieve out of it.
I think you make a point there, and just from some of the listeners on the webinar today are actual play the role of an allocator. And so the opportunity then would be to be in the long end if you want to take some duration risk. Is that a correct statement to make? That there's still opportunity in the long end of the curve where everything could shift down again. So if somebody was looking to add bonds to a portfolio from a portfolio construction perspective, there's still an opportunity there in something like our flexible bond or portable alpha bond. Am I correct in making that statement?
Most definitely. And I think to Michael's point, it depends on the benchmark as well, right? So if you benchmark yourself against the bond market, or if you wanted bond allocation in the portfolio, we would actually favor being long duration, being more at the back end of the curve, because there's more convexity, there's more benefit if yields come down. And as Michael said, we're not too worried about yields going up at this point. So for a bond fund, yes, we would be still long duration, but that shouldn't take away from the fact that the most attractive point generally across a curve is probably more at the front end, where you, as we think, erroneously are priced for hikes while they will not be delivered and there will eventually be cuts. So with that, for an income fund, you want to play like almost that barbell where you take some bond exposure probably at the back end, but then focus on the front end and harvest that real yield, which is very, very elevated.
Great. Thanks, folks. I see we don't have any more questions, so I'd like to then again say thanks for joining. Thanks, Bastian and Michael, for joining me for the questions. And again, thanks everybody for being here and spending the time with us today. And we look forward to seeing you in the marketplace and obviously joining us for future webinars. Thank you.
Thank you.